Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stocks chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into Krishca Strapping. So KSSL is a Chennai-based manufacturer and wholesaler of high-tensile steel straps, strapping seals, and strapping tools for packaging. It has India's first lead-free and eco-friendly production line for the heat treatment of steel strapping, with a 10% market share in the Indian steel strapping market. Now, some of their key clients include Hyundai Steel, Shyam Metallics, Vedanta, SAIL, Jindal, JSW Steel, among others. Coming to their product portfolio, so it mainly composes of three categories of products. One is steel straps, one is strapping seals, and another is strapping tools. So breaking up each one of them, so in steel straps, they can be categorized into two categories based on product finish, where we can see blue tempered and waxed straps, painted and waxed straps, and zinc coated and waxed straps. And in terms of winding types, it can be classified into ribbon winding, mill winding, and super jumbo coil. Coming to the steel seals, so they are made from high quality CR sheets using advanced machinery, and the company is committed to delivering innovative and reliable seals with their excellent customer service. So they can be classified into snap-on seals, push-type seals, thread-on seals, nest-stack seals, open flange seals, and open-type seals. Coming to the strapping tools, so here the company partners with top manufacturers to provide a complete range of steep strapping tools for various packaging applications, and their line of steel strapping tools includes the following, which includes combination, pneumatic combination, manual tensioners and sealers, and pneumatic tensioners and sealers. Coming to the industry overview, so the global steel industry has faced volatility due to inflation, geopolitical tensions, and tight monetary policies. The crude steel production remained flat in 2023 at 1,892 million tons, with China contributing over 50%. Developed markets like the US, European Union, and Japan saw subdued demand in FY24 amid rising high interest rates and slowdowns. Steel prices remained volatile due to Chinese exports and weak Eurozone activity, and India recorded a 13.2% rise in crude steel output to 144 million tons in FY24, becoming the world's second largest producer. Also, the finished steel consumption in India grew by 13.6% year on year to 136 million tons, driven by infrastructure and manufacturing. The global steel strapping market is expanding, driven by rising demand for safe and durable packaging, which is a huge industrial tailwind for Krishca Strapping. And in India, the demand is booming due to infrastructure build-out, smart cities, and rising industrial output. The automotive sector expansion is increasing demand for strapping of components and vehicles, and also steel strapping is also vital for securing solar panels and wind components in the renewable energy push. Coming to the Concall highlights, so the revenue grew by 43% year on year in FY25 despite the export margin pressures. EBITDA grew 20% year on year, but margins remained at 15% due to high employee expenses and export pressures. Also, the packaging contract revenue grew 4 times year on year to 12.88 crores, supported by a confirmed order book of 50.79 crores for FY26. Adding to that, Overall, the next 3-year packaging contract order book stands at 120.89 crores, ensuring strong revenue visibility for the company. Also, a cold rolling complex is underway and is expected to be operational by Q4 of FY26. Backward integration via the cold room mill is expected to add 4 to 5% margin and save around 4,000 rupees per ton input cost. Also, the cold roll mill related capex is 80 crores, out of which 40 crores have been already spent and 40 crores is yet to be spent this year. And the long term capex over the next 3 to 4 years is expected to be around 25 crore. Also, the which contributes around 20% of revenue, is under threat because of Chinese dumping, which has compressed export margins by $100 per ton. And primary packaging products, HDPE, tarpaulins, VCL, and airbags now contribute approx 26 crores and will be gradually manufactured in house. US exports, which contribute 1.5 crores in revenue, have been impacted due to uncertainty in duty structures. Also, FY26 revenue guidance is as 25 crore, 25% growth, with expected order book crossing 100 crores by half one. And FY26 overall capacity utilization was 60% and is expected to rise to 75% in FY26. And the company is targeting 5 to 6% packaging contract market share in FY26. Coming to the bull case scenario, so government initiatives in infrastructure, logistics, and EVs provide tailwinds for long-term packaging demand. Krishca is the first Indian manufacturer with a lead-free, eco-friendly steel strapping line, giving it a sustainability edge as well. And backward integration via the upcoming cold roll mill could boost margins and reduce input cost volatility. And adding to that, the company's packaging contract has seen a huge growth year on year and now dominates the order book, offering annuity like revenue. Also, the export potential remains untapped with only 20% of revenue coming from abroad, which offers huge room for global expansion. And the growing brand recognition among large industrial clients like Vedanta, Jindal Steel, SAIL boosts the company's credibility and retention, which is also beneficial for the company. Coming to the bear case scenario, so market margin volatility persists due to fluctuation in steel prices and rising input cost. Adding to that, export margins have been hit due to the Chinese steel dumping, especially in UAE and US markets, and can continue even further. Also, working capital intensity is high with cash conversion cycle at 230, and further inventory buildup could also pressure liquidity. Also, regulatory risk like the European Union CBAM or BIS norms and trade policy changes may affect margins and exports. So CBAM stands for Carbon Border Adjustment Mechanism and BIS stands for Basic Industrial Standard. So these norms would be important to look into. Coming to the 20 factor scorecard, so the company came up with this IPO in 2023. It was entirely a fresh issue of 18 crores, and the capex expenditure for setting up new strapping line was around 12 crores, and 3.75 crores was used to repay borrowings. In 2024, there was another preferential issue to non-promoters worth 50 crores approx, and warrant issue of 18.64 crores at INR 233 per share. So overall, the company has been raising a lot of funds recently, which has led to EPS dilution in near term. Because of that, I'm going to give it a 3 out of 5 here. Coming to promoter track record, so they have got a good promoter track record and the total promoter holding stands at 51.86%. So I'm going to give them a 5 out of 5 here. Coming to related party transactions, so there has been sales of good to enterprises owned by directors worth 6.5 crores. Also, the company has taken the loan from its managing director, Mr. Bala Manikandan, and which is worth around 15 crores. And the interest is still undisclosed about what the MD is getting from this loan deal. So that's why I'm going to give them a 3 out of 5 here. Regarding board independence and composition, so they have got 7 directors, out of which 3 are independent with 43% independent director contribution, and they have got 0 family on board, which is also good. So I'm going to give them a 5 out of 5 here. Regarding CEO or KMP salary, So their MD charges around 0.29% of sales as his salary, which is quite less. So I'm going to give them a 5 out of 5 here. Regarding key person resignations, so their independent director resigned in 2025, and one of their non-executive directors resigned in 2023, which does not seem much significant or much to be worried about. So that's why I'm going to give them a 5 out of 5 here. Coming to auditor resignation or change, so auditor has their tenure till 2027 and they are serving the second term. So I'm going to give them a 5 out of 5 here. Auditor opinion has been unmodified for the past 3 years. So here also they have done pretty well. And regarding regulatory or legal issue, so nothing could be found against the company. So I'm going to give them a 5 here. Regarding investor communication and disclosures, so the company does not do presentations very actively, but they do press releases and they do their con calls and they update their results half yearly. So I'm going to give them a 5 out of 5 here. Coming to the business concentration risk, so the company is quite concentrated, not only in terms of its customer concentration, but also in terms of the supplier concentration. So as of 2024, top 10 customers were contributing around 52% of the revenue, and top three in 2023 the number was much higher, with top 3 customers contributing 64% of revenue and top 10 75% of the revenue, which is quite high. Also, top 10 suppliers were contributing 93% of revenue in 2023 and top 5 were contributing 68%. So there is very high concentration both on the supplier and the demand side. So that's why I'm going to give them a 0 out of 5 here. Also, domestic sales contributed around 85% and export sales contributed around another 15% in FY24. Coming to CFO by EBITDA, so CFO by EBITDA is minus 83%, which is quite bad. And this happened due to high receivables and inventory. So I'm going to give them a 0 out of 5 here. Regarding revenue growth versus receivables, so revenue growth has been good. However, receivables have been growing at a much higher pace as compared to revenue. And receivables as a percentage of revenue is 28% now, which increased from 16.6% in 2023. So a huge increase. So I'm going to give them a 3 out of 5 here. Coming to the days sales outstanding, so also the inventory turnover ratio is at 1, which is on the lower side, and inventory days are at a 311 with inventory growth of 115% since last year, and inventory as a percentage of revenue contributes around 14%. So this inventory was built up in Q4 FY25 to leverage lower steel prices and service the upcoming contracts of the company. However, the numbers are quite high and also the DSO has also been increasing in the past 3 years. So that's why I'm going to give the 0 here. Regarding the cash conversion cycle, the number has increased from 110 last year to 230 this year, which is very high. This happened on account of high inventory and high and lower payable days with time. And at the same time, DSO has also been increased on the contrary. So I'm going to give them a 0 out of 5 here. Regarding capex versus revenue, so capex as the percentage of revenue is around 19%, with fixed asset turnover at 9 and asset turnover at 1.3, which is decent. Return on invested capital is 24 and it was 60 and 69% in the past 2 years. So on account of this, I'm going to give them a 5 out of 5 here. Regarding debt level and interest coverage, so debt to equity ratio is 0.3. Interest coverage ratio is around 5.3. So I'm going to give them a 5 out of 5 here. Liquidity position is also good. Quick ratio is around 1.7 and current ratio is around 2.9, both of which are on the higher side. So I'm going to give them a 5 out of 5 here. ROCE, ROE and ROA metrics are quite good. They're 17, 20 and 7%. However, they have significantly declined in the past 4 years. This happened because of the ongoing margin pressure which the company is facing globally and also domestically. So I'm going to give them a 3 out of 5 here. Regarding growth consistency, we can see the revenue growth has been good. However, PAT growth has been minus 11% since last year, and their margins have taken a huge hit, with EBITDA margin falling from 19% last year to 16% this year, and EBIT and PAT margin declining from 13% last year to 8% this year. So on account of this, I'm going to give them a 3 out of 5 here. Coming to their final score, so they scored 46 out of 50 in governance and promoter behavior and 24 out of 50 in financial health, taking the total score to 70 out of 100. Now coming to the valuation analysis.
So overall, on the promoter side, looks like the promoter has been very upfront when treating minority shareholders. Very small market cap company, 300 crores, but good return ratios. They knew the market opportunity for these kinds of products were huge. They're saying the market size is around 2,500 crores or something. So that's huge. And they have consistently maintained margins of above 15%. Let's consider the worst case now. I think that's a good estimate. They've grown exceedingly well. Considering 296 crores and 15% operating margin and a PE, I would give it as 15. The price target comes to 302. The price is at 224. So if the company is able to grow at the current rate, and even if there's some margin compression, then there looks like, or even on a 1 year forward basis, there is some margin of safety. Okay, the caveat being they are able to almost double even in the next year. But sorry, I missed it. Did they guide for doubling?
No, they guided 25% year-on-year growth.
So in that case, then a lot of things is looks like already factored in. So even if you put a 10 PE, then a lot of it is basically I'm playing with the PE so that it justifies. So it looks like it is
We
factored,
already
and
have
this
got
tool
a
doesn't allow us.
order book, so that
Yeah,
way
uh,
it's unlikely to reach
yeah.
four.
This tool doesn't allow us to. Yeah,
Yeah.
this no, not. I'm taking the worst case. This tool doesn't allow us to change the sales figure, so that's a
Maybe we could
drawback.
toggle the margin so that the EBITDA growth comes in line with the projection.
I've toggled with the PE, so I've given it a 10 PE. So it's currently trading at 26 PE. So let's see. So the net profit is 12. And since it's negative operating cash flow, let's take that figure and let's see if we have a higher figure, a higher number of years, whether the required rate matches a rate of return. So considering we require 25% return and terminal growth rate of 3 and our holding period is 5 and terminal multiple is 15. So the implied earnings from this price, the company has to grow at 32%, but the management is expecting that they would grow at 25% plus. So it looks there's no much margin of safety based on reverse DCF that we have done. One thing is I can't understand the moat in this business. They've grown well, so try to see what moat or competitive advantage the business carries, because it looks like more commoditized product for me. So that's the only take.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.